maybe the worst trait in a founder that will get worse and worse over time, in many cases will maybe push you out of your own company as a CEO, is precisely the element you're referring to, which is self-awareness. I would call it intellectual dishonesty, right? So if you're intellectually dishonest and you're like, I know it all, I don't need anyone to coach me, I don't need whatever to scale myself, the likelihood you'll fail increases exponentially as you go through stages of funding, right? It is very, very likely that at some point you'll fail as a CEO. And this is the other extreme is also bad. The walkover, nice CEO who doesn't take decisions, who doesn't have a perspective or point of view, he or she will also not make it.
Welcome to the latest episode of the Raise and Exit podcast. We are excited to have with us today Nuno from Chameleon Venture Capital. But I'm going to actually let Nuno introduce himself with the true pronunciation of his name, and as a reflection of the fact that he's lived in dozens of countries and embraced a commensurate amount of cultures. So Nuno, please introduce yourself in its fullest glory.
Oh, well, my name is Nuno Gonçalves Pedro. Nuno is a very Portuguese name, Gonçalves, I guess, as well. And so, yeah, that's the proper pronunciation of it in Portuguese. Nuno Gonçalves Pedro.
That is super cool. And please tell us a little bit about chameleon.vc. For those that might not know,
Yeah.
you, of course, are an active investor in seed and Series A. It's going to be a big catalyst for the questions I'm going to have for you today. But introduce us and help people kind of self-select as to why they should reach out to you for a check or an investment.
I mean, Chameleon is an early stage venture capital firm. We focus on investing on what is normally known as Series Seed and Series A, so early stages of investment. We're typically the first institutional investor to come into a company. And at Series Seed, we tend to lead, take board seats, do the usual things that a classic venture capital firm does. We have a skew towards US investing. We can invest in other parts of the world as well, but typically we have a skew towards US investing. A couple of things to sort of put at the table. First and foremost, pretty amazing team around the table. Me and my partners have been doing this for a long, long time. It's a little bit of a trifecta of people that have been entrepreneurs themselves, operators at scale, like the 10 to 1,000, 10 to 10,000 kind of scale up. And finally, investors for a very long time. The second claim to fame is unlike almost any venture capital firm, we actually develop our own tech stack. So VCs invest in technology, but they don't develop their own tech. So think of us, if you guys have heard about Renaissance Technologies, sort of the innovator in the hedge fund field by creating really the first ever quant hedge fund. We're sort of doing the same for early stage investing. And we have developed a platform called Mantis. You sort of see where this is going, names of animals along the way, which is to our knowledge, the only operating system in venture capital available. We only use it for our own purposes, and we share it with our limited partners, our own investors, and with our portfolio companies, which are the companies we invest in. So typically, the activity of venture capital is known for we invest in startups, and then we hope that they go really, really big. Either they sell to someone or they become a public company. But we also have other types of clients, and the other types of clients are the people that gives us money. We also have our own investors, and those are called limited partners for those of you that are less aware about how venture capital actually works.
I love how you're kind of putting there, because what you're conveying is it's not just access to capital. It's not just access to people who've 10,000x their businesses. But I think it's that sophistication of the ecosystem, because I think what sometimes people forget about venture capital investing is that these are not 1 to 2 year relationships. These are often 5, 6, 10, sometimes 15-year relationships. And the fact that you're going and building into exclusive access technology in the background, I think resonates a lot for me, because it's just kind of like that extra advantage or that extra edge of being able to go and get investment from yourself and your team. And I kind of really espouse for a lot of the early stage companies that we work with, it's like you really want to understand what you're getting beyond the money from who you're going and getting your investment with, or who you even approach. And tell me a bit more about that aspect of it, because at Seed and Series A, it's the bridge from product market fit to commercialization. How should founders be looking at that as a way of preparing themselves to approach somebody like you for investment?
Let me just step back in a second and I'll answer your question. The industry, I think venture capital has this really bad habit of talking about proprietary networks, about like, I'm a venture capital investor. I've had great performance in my previous fund, and then that somehow is an indicator that I'll have great performance in this fund. But there's very little repeatability on how things are done, right? You could say I'm an amazing picker, and there's, I'm a great
Yeah.
managing partner or a partner of a firm, and I'm an amazing picker. Proprietary networks have disappeared. The world is relatively flat. You can reach out to anyone in the world and get their attention in some ways. And so, in some ways, proprietary networks were related to this old school view of venture capital after World War II, which is when the asset class was created, of people really meeting at country clubs and in different
Yeah.
occasions and creating that trust. That doesn't exist anymore. Now people are looking, and maybe this is a good segue to answering your question. They're looking at actual numbers, right? And there's a lot of cherry picking in venture capital investing. So Series Seed, what you're normally looking at, and I have to sort of differentiate a little bit between B2B and B2C, and then between physical and software. So a lot of the things I'm saying are a little bit generalist. But basically, you have to sort of figure out which space do you fit in, and there might be some different answers depending where you fit in. But lo and behold, to your point, in Series Seed investing, we're looking for not really product market fit yet, but we're looking for sort of this nexus of product, market, and team that leads us to believe that you have a high chance of product market fit.
Yes.
In some
Yeah.
ways, we're trying to cheat the analysis of the product market fit and say you're probably going to be on your way, and within a year, year and a half, you might reach it. And magically within a year, year and a half, in today's world, probably in 2 years to 2 years and a half, because you need to last longer in the market. It's difficult to raise. You need to get to that stage, which is Series A, to your point, where you have achieved product market fit and you're sort of a little bit more ready to scale up. So anyone that's looking at you, in particular institutional investors, I'm not talking about your friends and family, which is normally where you should start raising money from. I'm not talking about your angel investors. I'm not talking about your micro single GP kind of funds. I'm talking about an institutional venture capital firm like ourselves. We're looking at data that allows us to de-risk the deal. So we're looking at data that allows us to think that at that nexus of product, market, and team, you have a really high chance to make it to real product market fit. Then when we're looking at Series A investing, because we also invest in Series A, we're looking at a different set of things. We are looking at product market fit signals already. And, for example, if you're a consumer company, we're going to spend a ton of time looking, for example, at cohort analysis around your user base, really trying to figure out how does your traction match your retention, your engagement, how does your funnel fit? How many users are you losing around your funnel? If we're looking at a SaaS company, we're looking at, annualized recurring revenue. We're looking at your growth rate. We're looking at your go-to-market. In some cases, we might actually even be looking at unit economics, which is typically something that's a little bit more associated with Series B and Series C investing, right? But at that point in time, we're looking for, again, cheats that your unit economics work, even if you have great numbers on your user base in terms of your revenue and monetization. So just to be clear, it all seems very easy. And a lot of VCs will tell you, oh, I'm a seed investor and I only look at team. Maybe 90% of the people that say that really believe it. And then I would say some of them are probably a little bit too lazy because at the very least, they can also do market analysis. And, there's a lot of market indications that you can do in parallel. But I would say most VC firms, at least the VC firms that you'd probably want on your cap table that are a little bit more evolved, are looking at a lot of nuanced signals that allow them to think through, is this a 10x, 20x, 30x potential return for me? And if it's not, probably I won't invest. Or if the risk is too high for, potentially an upside that is on the smaller side, also potentially I won't invest.
I love what you say there because you're bringing together to me, which is like a deep passion for me, which is a relationship between capital. Like this is venture capital. I think sometimes people forget. We've abstracted it by calling it VC. We've abstracted it by calling it a raise. But it's capital, it's risk. And I love how you went and put the de-risking and its due diligence. And what I'm hearing in here is this is way more of a science in terms of its potential than I think some people aspire to. And it makes sense that you've gone and built what you built at Chameleon to support this environment. And it's kind of, so I want to kind of take on that note, and maybe this is one of these de-risking signals. What are you seeing is a de-risking signal for a Series A ready founder that they might not need at seed, but they sure as heck need to have figured out by Series A?
I already mentioned one, which is product market fit as an indication, right? So the intersection of traction, retention, engagement, monetization altogether as a signal of product market fit
So that's at the company
means that you
level.
have a growing market.
That's at the
Oh, you're
company
talking
level.
about the
I'm at the
individual.
person, at the individual level.
Yeah.
What do they need to go and skill themselves in? Because I get the team and the attitude aspect, But is there a
Yeah.
skill requirement that you think is needed from seed to Series A?
So assuming if you've already raised the Series Seed, it's likely that you're a strong founder, right? You
Yeah.
might not be exceptional, but you're at least a strong founder. I mean, at the very least, you're a BB plus player. We, for example, only like to look at AA plus players, right? So
Yeah.
our bar is probably higher than many firms. Is we don't think markets alone, can do justice to how you're scaling. So it's likely that you'll have a couple of superpowers, and those superpowers reside normally in different areas. If you're a B2B SaaS founder, CEO, normally your superpowers will either be in product or it will be in go-to-market, some element of go-to-market, maybe sales, maybe marketing, maybe channel strategy. There has to be something that's a superpower. So that's a given. You're already exceptional at that. That's probably why someone else has invested in you before, an institutional investor like ourselves or other investors out there in the market. So at Series A level, the question is, what are my gaps? And likely your gaps are going to be, for example, B2B SaaS as an example, the extension of your go-to-market playbook. You
Mm.
might start with founder-led sales, but you might actually, for example, not have hired anyone around customer experience, customer onboarding, etc. It might be that you're exceptional at, for example, marketing, but you have not really done sales very well, right? So you're a great marketeer, you figured out how to do SEO, you have maybe people even on your team that doing a lot of paid advertising and optimize performance marketing, but you actually have no clue on how to scale sales. Or you're extremely good at field sales and you're a great founder in terms of sales and you're great at getting that meeting, getting the person on board, doing that enterprise sales, getting that logo on board, but you understand nothing about the scalability of inside sales. So there's always these little elements that you need to have on board. And to be very, very honest, most of them you can hire for.
Yes.
Okay. You'll hire people for that role. So it's not like you need to do all the roles, just to be clear. You have raised money on C to scale your team, and you're looking at the Series A to also raise money to further scale your team. So if you have a trajectory that convinces someone to lead a Series A in your company, you can basically say part of my use of funds, a significant part of it is to hire people that are going to complement me and the existing team on these different areas. Now, the part that's exciting about your question is what's still my gap as a founder? And what I've realized, it's normally resides within a couple of elements. One is the admin financial piece of your business. I'm still to meet a lot of founders, most founders, even exceptional founders, have very little clue of what's happening in their books. And they
Mm.
have maybe a consulting CFO looking at their books or an accountant looking at their books, and they miss stuff. They misrepresent some of their revenues. They misrepresent some of their numbers. And it's not fraud, just to be clear. I mean, it might be
Yeah,
in some
but
cases,
it's
extreme
great what
cases.
you're saying
In
there
general,
because
it's not.
it'll show up in due diligence and it'll almost kind of catch them on the back foot, right? It's
Exactly.
that transparency. I love what you say there. Keep going. This is great.
You have to have a little bit of financial literacy. I mean, you could have a full-time CFO at some point, probably not at Series A. We're probably talking something that will happen much later on. But you have to have financial literacy. You need to understand your numbers because 95% plus of companies fail because of lack of funds. They don't have enough
Hmm.
cash in the bank, right? So if you're not managing your cash and you don't understand what's happening, good luck to you. A second element is sort of this tension between leadership and management. I think being a great leader and being a great manager are not the same thing. There's a lot of confusion around it. A leader is someone who can catalyze people, sometimes even without necessarily having a great plan in mind. I think this was a friend of mine who once told me, like, if the objective function is to go to hell and back, a leader will be the person that will get everyone pumped up to go to hell and back. Maybe you make it, maybe you don't, right? A manager is the person that will set up and define all the plans for you to go to hell and back, right? Now, most cases, it could be that you fail going to hell and back, but the second time you try it, the likelihood that the manager will have a better understanding of what failed is higher. But will he or she be able to catalyze the team again? Question mark. Whereas the leader probably will have spent a lot of his cartridges the first time around, and the probability that he or she will have of actually setting the stage to go back and forth is also not a given. So there's different elements to this, and I
Yeah.
think we've seen a lot of entrepreneurs that fall into either great manager or great leader, but not both. And in a startup environment, you need to be really pretty good at both. And so enhancing your ability to manage, your ability to delegate, your ability to give functions to other people and explain to them how they deliver on it. The ability to actually empower people is something that fails a lot in entrepreneurs. They're very good at doing it themselves or managing it themselves, but they're not very good at empowering other people. On the same side, the ability for me to catalyze people to really convince people of that reality distortion field that we've talked so much around amazing CEOs like, Steve Jobs, etc. That's pretty crucial in a startup because people are going to work 90 to 100-hour weeks, and you need to get them on board. You need to get them at the table, and be willing to work those amounts of hours. And so that amount of leadership is there. And I think leadership and management, there's always stuff missing
Yeah.
around the table.
I love kind of like there's so much you just had there. Like I almost want to like kind of unpack it. Like I'm picking up a few things from what you said. Like I think one is like almost like a proactive ability to have self awareness. It's not just having self awareness, but almost like having an inquiry into, hey, what am I weak at, and be able to do that. And actually, on that note, does it strengthen the rate?
Edgar, sorry
Yeah, go
to
ahead,
interrupt you, but there's a point you just said that is very, very crucial.
please.
Maybe the worst trait in a founder that will get worse and worse over time, in many cases will maybe push you out of your own company as a CEO, is precisely the element you're referring to, which is self-awareness. I would call it intellectual dishonesty, right?
Mm-hmm.
So if you're intellectually dishonest and you're like, I know it all, I don't need anyone to coach me, I don't need whatever to skill myself, the likelihood you'll fail increases exponentially as you go through stages of funding, right?
That's
It is
so
very, very
useful.
likely that at some point you'll fail as a CEO. The ability for you to bring in the right talent around you, etc. And this is the other extreme is also bad. The walkover, nice CEO who doesn't take decisions, who doesn't have a perspective or point of view, he or she will also not make it,
Yeah,
right? So you have to be in that middle. You have to have strong opinions, loosely held in some cases, and you have to have really an amazing team around you, in particular on the areas where you need complementarity.
that's so good. So we got the self awareness, being able to go and take a look at it. I love what you went into about like the intellectual dishonesty because like look, you have to have a certain amount, and I say this in a good way. You have to have a certain amount of crazy to be able to be a founder, right? Because you need to be able to
Mm,
go and push yourself. Like as a founder, I think the reality is you're committing yourself to like 8 to 15 years of your life towards some kind
mm.
of cause that is going to evolve in ways that you did never imagine when you started the company. So you have to be ready for that change and those pivots that is there. And another thing that I kind of picked up is that ability to delegate oneself, which is not necessarily the same as delegating a task or a skill. Like you actually have to
Mm.
find people that can be extensions of your own ability to do it because you cannot do it all. And I
Yeah.
love that nuance that you've kind of brought in there into what you're saying. So this actually brings me to another question too, because you said you're looking for those A's and A plus founders. What happens if you see the vision at that seed or series A stage that is larger than the founder that you're talking to? Has that happened? What do you do?
It happens, and it's a conversation and a dialogue. I think we venture capitalists, in the setting, for example, of a game, the best venture capitalists become coaches, right? We are
Mm,
the people that are able to coach. We're the Phil Jacksons of the world, right? That's the best case scenario. And to be very honest, the industry, the odds that you'll end up in that kind of case of being a coach and you have the skills to be a coach, etc., it's maybe only 3 to 5% of VCs in any given environment. Then there's the boo-booers, the people that think that they do better than the players. So I'm gonna go and I'm gonna play, right?
yeah,
And they're like, get out of my way, right? So or the people from the audience that are throwing stuff at the players because they're like, I could do that better than you, right? You just missed that goal, or you just missed that basket, or whatever. Which I'd say probably around 5 to 10% of the industry, so a little bit more than the coaching
mm-hmm,
staff, so to speak. And then the rest, to be honest, and that's what the industry is filled with. 85 to 90% of the industry is cheerleaders, people that
yeah,
are there, and while you're doing great, you're amazing, and when you're not doing great, they go away, they don't show up, right? And that's sort of the majority of the industry, and sadly I think that's where we end up. We try to be coaches, my partners, myself, we try to be coaches, which means sometimes you need to take time to tell someone you're smoking dope, this is not working.
yeah.
And it might be a matter of vision and strategy, it might be a matter of execution, operations, it might be a matter of lacking of skills. The person's really not the right person to take the company to the next level. The point you just pointed out of vision, not having enough vision in terms of ambition, I don't think that's necessarily a showstopper, or something that would lead a conversation around maybe you're not the right CEO for the company. It might be just that the person wants to execute at a more operational level and we'll get there. It's going to take the years that it needs to take. And that kind of visioning and amplitude will come with time, right?
That's really good because you're
So I don't
pointing
think
to the
that's a
wisdom.
showstopper.
Yeah, and I don't think I
Yeah,
would view it as such, but I think it sometimes becomes awkward, right? Because it's an ego,
yeah.
it's an ego disruption too. Because people are like, "I have this grand vision," and you're like, "Oh, you can be bigger," and like some people will take it as an insult, but like I'm listening to it, I'm like crap, like you've gone and
I,
looked at I don't know how many deals, you've invested in so many companies, like you have I'm like you're decades ahead on perspective from some of these founders, and it's not a
I'm at
criticism of them.
best. Yeah, where it's best, you could say, look, if you think I'm credible, this is how I'm seeing it, and we'll
Yes.
have a dialogue and a conversation. Normally, it means you need to involve other third parties, maybe advisors, other board members, other people on the team that are willing to sort of step up and say, look, I actually agree with this perspective, that there's a bigger vision here involved. And then you go into that dialogue and then you try and create a process around that dialogue, which might be a strategy exercise, a mini piece of work that you would do with someone as an advisor or whatever, something that would lead us to sort of jump to the next level.
Yeah.
The opposite also happens. Like I could see there's a huge bottleneck. You're going after this crappy submarket. It's going to hit you on the head. And it happens quite a bit. I mean, if you're relatively good as an investor, as a VC, it's happened to me with a couple of my portfolio companies over time. It's like I tell them day one, once they decide to go into a new go-to-market, this sub-market, etc., I don't think that's going to be great. 3 months in, it's like, and then it takes them a year to a year and a half maybe to realize that actually the market was crap. And you're like,
That's
well, could you avoided it? Not really,
yeah.
because again, we sometimes do need to replace CEOs and roles, and I've done that in my career a couple of times. But the key objective when we invest in a company is that we invest in that founding team, in particular that founder CEO, with the belief that that person can take the company to the next level. It's part of the bundle we're investing in. It's not
Yes.
separate from the bundle. We're not investing in a company that is in the market, that has something in product market fit. We're investing in all of that plus a founding team and a CEO, right? And if the person fails miserably, they fail miserably, we may need to replace him or her. But in any case, our objective is to really scale that person up, as you mentioned in one of your earlier questions, scale that person to the next level. And so we have to go through the journey, whatever time it takes. And sometimes it takes much longer than you thought it should.
Oh, this is, it's I'm, like I'm
And
listening to
sometimes we're
you.
wrong as well. Just to be
Yeah.
clear, sometimes we're wrong as well. I mean, I've been wrong. I mean,
So wait, no,
to be
you're
very
telling
honest,
me that.
I've been less wrong than I've been right. So I've been much more right than I've been wrong.
So wait, you're saying
But
you're not
it took me
flawless?
decades.
You're not flawless?
I'm
No,
not
no, come
flawless.
on.
Nobody's flawless. Nobody's flawless. I mean, I've had guys who pivoted and you're like, what the hell is that pivot, right? And magically the company works out.
Yeah.
I've had a consumer company. The guy, if he listens to this, he knows who he is. Consumer company that early on said we're going to create a subscription-based model, and I just invested in another consumer company that created a subscription-based model that led them to death. And this
Yeah.
guy said that, and I was super skeptical for 6 months, 9 months. The guy did a bunch of tests, launched in the market. The company still makes money. Company pays dividends. They've never exited, but I'm now several times over returns on that company. I've been on that board for 12 years. I mean,
Nice.
but the returns keep going up, and the guy was right. The founder was right.
I want
That
to
was the way to go.
I want to actually pull back something because as you were just talking there previously, one of the things that I saw is like I'm a big fan of fantasy sports, which really
Mm,
is kind of like the statistical modeling and the expectations of like the people that are at the pinnacle of the game, and and as you're saying, I'm like I'm just seeing more of that philosophical context that you have behind going and building that back end and the systems inside Chameleon for you to work with the companies that you're investing into because I'm actually seeing the same thing I'm bringing in signal and intel that I cannot get any other way. Like you look at how analytics departments have
mm,
skyrocketed inside sports teams. I almost hear like you're building out like analytical capability inside your funding teams, right? Like the teams that you're investing into.
mm.
And I don't think there's enough credit being given to it. Like I still find it's weird how much venture capital is still on a I spray enough, I'm going to go and win some. And I think you're becoming more precise because when you went and said we win more often or we're right more often than we're wrong, I actually don't hear a lot of VCs admitting to that. They would rather go and say I had some really big hits and then they kind of hide away from the amount of
Yeah,
misses that they had. Does that resonate?
it does. I think, let me just add to the point you were making. There's something happening right now in venture capital that's even worse than that,
Say
which
more.
is this migration to brand arbitrage, where the big brands are raising mega funds, billions of dollars, and anyone that's been in venture capital for any number of years would tell you the returns are not the same if you're doing a billion, $2 billion fund, right? I mean, at some point you're hitting difficulty in scaling the business. And if you're deploying that much capital, it's likely that you're deploying it mid stage and onwards, which effectively means if I'm a fund that has a billion, 2 billion in under management in a fund, or a firm that has 1 to 2 billion under management in a specific fund, if I'm writing smaller checks at the beginning, those are optional checks. Those are not my returns. It's more not where I'm going to center my attention. So effectively, all the funds are running almost what we used to call as opportunity funds.
Yeah.
I'm just getting positions into small positions into a lot of companies and then doubling down later stage. And that actually predicates almost like an emptying of real early stage investing, of real early stage. I'm with you through your route. Because if I give you a 500K $1 million check and I'm a huge fund and you don't deliver amazing growth, I'm not going to put more money in you. And that's also the opposite, a kiss of death, right? It creates a very negative bias for any other investors. Why didn't those guys put more money in? They have a ton of capital. So
Yeah.
there's something happening right now in the industry which is even worse, which is sort of this really insidious notion that more money is better for venture capital when it's not. It's a different asset class. Venture capital for me is Series C all the way through Series B at max. Everything after that is growth investing. There's private equity. There's all sorts of things going on in later stages. And if we continue pretending that what's happening today in the industry is positive, that actually is
Oh,
not true at any point in time.
this is such a gold mine because look, the whole history of venture has been around punching above your weight because of scarcity of resources, right? And what you're pointing to there, it's almost like maybe it's a statement of saying like we're making lazy founders as a result of having too much capital that they're able to go and tap into potentially.
It's lazy founders, but the guys who are going to be, it's going to be haves and have-nots. If I'm doing a non-AI company and I don't have this ridiculous pedigree of stuff that I've done before, it's going
Yeah,
to be very difficult for me to raise money. And right now, to be very clear, we are in a bubble. We're
yeah.
an asset class bubble around AI. I mean, most
I
of the companies that are out there, even around foundational models and infrastructure, are going to die. They're full stop, right? So it's going to be a bloodbath.
I look,
So,
I come from
and
a
we've seen
long
it
term.
before.
I come from a long term investment background as well in my career, and I'm right now I'm doing like just back of the napkin scratch. I'm like I think there's a 70% downside onto the current valuation in AI collectively because we've gotten seen it in other categories. Like this is just the wave of the next kind of jump in terms of what we go and have. But that's a whole other conversation. I do want to kind of close out today's session with you because I want to take a look at what has running your own podcast and where you've had to articulate your philosophy and your thoughts and your vision on the market. How is that giving you an advantage in how you invest? And what should a
The podcast.
founder what should a founder take from that as a way of making themselves better?
I had a friend of mine who used to call the logic of natural stupidity, right? Some stuff happens accidentally, right?
Yeah,
The reason why I started Tech Deciphered with Bertrand, my co-host and co-founder, and we don't have guests, by the way, on our podcast,
yeah.
was we wanted to work together. I'd invested in this company. We were very good friends. I'd influenced strategically the company in many dimensions, and we just wanted to work together on the ground. And so I think the lessons learned of doing it together with him is it's become a very good way of keeping my brain top-down focused. I was a senior expert and member of the Asia Pacific Technology, Media, and Telecom leadership team at McKinsey, and I've led strategy, corporate, and business development for organizations. I've done strategy at scale. But when you go into sort of the venture capital space, at some point you have a tendency to go a little bit more bottom up in terms of analysis, right? And forget some of the fundamentals, architectural view of the world. So in some ways, it's been very helpful to have a little bit the prepared mind, right?
Hmm.
Which is, once you have a top-down architecture on the world and see what are the trends and megatrends around a specific topic, your brain starts getting a little bit more ready for recognition, right? Once you see it, you're like, okay, this is interesting. This matches something that I thought and talked about. So it's become a really powerful way for me to further enhance sort of my top-down view of the world, to get into topics that honestly, some of the topics were not natural for me to go into, a lot of depth or a lot of interest. So it's been super helpful. And also, last but not the least, to help me become a better communicator.
Yeah.
And a lot of people will say, I think, I'm not born in the US. I'm now a dual citizen, but I'm not born in the US. And everyone takes communication in the US as a given. I always say this country is built on marketing and sales. So it's sort of a given that everyone's a great communicator. You'll find these amazing hustlers who sometimes are empty suits. They have no actual substance of knowledge, but they'll be great at pitching as if they are, right? But communication is indeed very, very important because communication is what moves people to action, right? I was a strategist for many years at McKinsey, as I said. And the core thing is how do you communicate, either through slides or verbally, so that you get people to action, to do something that they understand that they need to do, and to be able to explain to them what it is that they need to do. And so that's why I would say that was an amazing benefit of creating a podcast, which is how you enhance your communication skills so that you become more impactful in all your relationship with your founders, with your investors, etc.
That's so cool. Like my takeaway is that you're almost kind of like making sure that you're just ahead of what you're stepping into at any given time. This has been so valuable. I have so many other questions I want to ask you, Nuno. It might have to be for a future session. Thank you for your contribution today. And for our listeners, I hope you got something from here, not just in terms of approaching Chameleon, but also just building your own business. Thank you, everyone.
Thank
Thank
you.
you, Nuno. Cheers. My session with Nuno gave me some really deep insight into how to think about what makes the top tier of venture-backed companies or early-stage companies through their life, not just what is a great idea. And I think the piece that really kind of jumped out for me was the fact that you need to both be a leader and a manager inside a company to be able to bring it to greatness. And it's not that you know how to manage what is already there, but it's actually the creation of the management architecture. And to go and take a look at like what is valuable for you now versus what you need to go and create to get to that next hurdle of value. And some of it was also scary, like the whole notion of like, it's to go to hell and back. But in some respects, it is the business equivalent of this. So I think a great takeaway for me from this was, if I'm a founder, which I am, but in a different way, what do I need to go and consider is my stumbling block? What is the thing that is my biggest impairment for going and creating the systems or leading my team or empowering my team to be able to get to the next level, and find and fill that hole for myself, and thereby exhibit that management and that leadership that one must have to be able to go and build these exceptional companies that Nuno has had the part of being for so many years. Hopefully this added some fantastic value and thought for you for the coming months and years.